Good morning, we are group number 3. Today we are going to present the topic earnings and stock price. The group members including Christine Chen, Junze Wu, Xiaoqing Wen, Weimen Wu, Xiaoke Yang, and Zimo Yang. So here is the agenda for our presentation. First, we are going to talk about the articles. They are including an empirical evaluation of accounting income numbers and the information contents of annual earning announcement, the information contents of security price. In each article, we are going to talk about the introduction, why and how do the researchers conduct the study, and the conclusion. Then we will make a final connection between those three articles and finish up our presentation and open to questions. Let's talk about the introductions for Ball and Brown's study. Before we dive in, let's talk about a scandal first. The 24th of February 2003 has been renamed Black Monday. The day one of the biggest companies in Dutch stock exchange was rewarded to be important accounting malpractice. Royal Ahold, the parent company of Dutch company, turns now to overstated earnings of food service by $880 million and would hold crucial information from their accountants. In a couple of days, the CEO and CFO were forced to resign. Besides that, they were accused of fraud at facing jail time of big penalties. The practice of CEO and CFO dubbed everyone involved in old stock, including big banks, pensions, and insurers. But it also brings us something positive. A whole stock shows clearly that the stock price efficiently reflected all knowing information. A whole immediately cut punished when the war came out. They were manipulating the earnings. This directly related to the research done in a paper which we're going to look at today by Ball and Brown. So before the research of Ball and Brown in 1968, accounting research was mainly based on few assertions and derived arguments on which accounting academics based on research outcomes. The belief of accounting research was that accounting income numbers do not have any values as different financial accountings are added up and valued differently by firm, and therefore were considered useless. However, Ball and Brown's questioned the uselessness of accounting income numbers by performing an empirical test. The name of the ideas of Ball and Brown's is that information is already incorporated in the stock price by investors. As investors will adopt their buying or selling behavior to this information during the year. As a result of that, Ball and Brown changed the way of conducting research in accounting. This made them pioneers in the fields of accounting research to share with the importance of outcomes of this research. So what Ball and Brown study for? Let's talk about example first. Sam is a stock trader at Wall Street. Every day Sam may receive a lot of information about his investment and make decisions to buy or sell stock using his information. 1 week before the accounting income number unannounced, he questioned himself what the impact of announcement of those numbers will have on the stocks. Are they increasing or decreasing in value? This is exactly what Ball and Brown's looking for. Ball and Brown's research is testing the usefulness of accounting information numbers. Since completely an analytical approach to usefulness never been done before. So what Ball and Brown study is if the accounting information number announced at year-end are useful for investors. Useful can be defined in two ways: timeliness and content. Then, how Ball and Brown conducted the study. Ball and Brown compared the firm's specific change in stock price with the unexpected change in accounting income numbers from 1 year before the announcement of the accounting income number until 6 months after announcement. The unexpected accounting income number is equal to the actual income change minus the expected income change. You guys can take a look at the picture to better understand the range mentioned above. Now I will pass to Wayman to talk about the data related with Ball and Brown study. Thank you.
Now let's talk about the data applied here. Three classes of data are important for the study: income numbers, annual report announcement dates, and stock prices. In addition, two models with three variables are applied to illustrate the data, which includes net income and earnings per share for Model 1, regression model, another earnings per share for Model 2, naive model. We can talk more details about these two models. For Model 1, income expected by the market, and Model 2, market reaction on the results of their expectation is false. The Model 2 is considered as the most reliable forecast model in this case. Also, using additional variables, cash flows, and net income before non-recurring items, it is not successful to predict the size of stock return residuals. Now I will apply three tables to discuss the data mentioned before. The table 1 is related to income numbers. The data were captured from 1946 to 1966. The distributions of the square coefficients of correlation between the changes in the incomes of the individuals and the changes in the market's income index are summarized in the table. We can tell that about one-fourth of the variabilities in the median firm's income can be associated with the changes in the market index. Next, let's go to Table 2, which is related to the annual report announcement dates. Three kinds of annual report announcements are published by the Wall Street Journal: forecast of the year's income, preliminary report, and the complete annual report. While forecasts are often imprecise, the preliminary report is typically a condensed preview of the annual report. Table 2 reveals that the time lag between the end of the fiscal year and the release of the annual report has been declining throughout the sample period. Lastly, Table 3 is related to stock prices. The data used for monthly closing prices on the New York Stock Exchange, adjusted for dividends and capital changes. Table 3 presents the distributions of return regression and residuals autocorrelations. Here, let's talk about the study relying on the results provided. The results are presented in two forms. The left form is for three portfolios constructed from all companies and years in which the income forecast errors. Based on each of the three variables, we can tell that they were positive from the top half. For the bottom half, we can see that the income forecast error were negative. And lastly, for a single portfolio consisting of all companies and years in the sample, we can tell that the line which wanders just below the line dividing the two halves. Since the result of the left form may be sensitive to the distributions of the stock return disturbance, a form on the right side is presented. The third column under each variable heading in the form gives a 2x2 classification by the size of the income forecast error and the size of the stock return residuals for that month. Actually, both two forms convey the same picture. Here we can also summarize some key results presented. First, Abnormal stock returns are positively correlated with earnings news, which means that earnings are informative to investors. Second, investors anticipate earnings news as much as 12 months in advance. This suggests not only the market begins to anticipate forecast errors early in the 12 months preceding the report, but also that it continues to do so with increasing success throughout the year. Next, it takes about 2 months after the earnings announcement until earnings news is fully adjusted into prices. An explanation for this could be that preliminary reports are not perceived by the market as being final. That is, even if the relationship tended to persist beyond the announcement months, it is clear that unless transaction costs were within about 1%, which was no opportunities for abnormal profit once the income information had become generally available. Last, the value of information conveyed by the income number at the time of its release constitutes, on average, only 20%. Now let's make some conclusions for the study. First, accounting income numbers are useful because of the contents instead of the timeliness. Second, most of the information is already valued at stock prices when announced. About 85 to 90% of the information of the accounting income numbers are already captured in the stock prices. Last, Ball and Brown set up a comparison of stock prices of individual firms with the market averages. Since the efficiency of the capital market is largely determined by the adequacy of its data sources, we do not find it disconcerting that the market has turned to other sources which can be acted upon more promptly than annual net income. Now I will pass to Ginger to talk about the second paper. Thank you.
Thank you, Jianqiao. Now I will be going over the second paper, the information content of annual earnings announcements. The paper is written by William Henry Bever, and it was published in 1968. This research is considered one of the most important seminal works in the capital market research. The paper mainly talks about how common stock investors perceive earnings to possess informational value. So the study directs its attention to investor reaction to earnings announcements, which was reflected in volume and price movements of common stock in the weeks surrounding the announcement date. But why doing this research? What is the motivation? So according to the paper, the information content of earnings is an issue of obvious importance and is a focal point for many measurement controversies in accounting. Financial statements were considered to be better indicators of company value, and that investors felt that measurement errors in earnings corrupt the accounting metrics. In addition, most of the information in accounting statements could be found in more timely and less costly. So, although financial statements do not reflect economic reality, they are the best available resource that investors can utilize. What is information content? In order to understand this, we need first to understand what is the information. The book defines information as change in expectations of the outcome of an event. So in this paper, a firm's earnings announcement have information content if it leads to a change in stock investors' investment decisions. If earnings reports have information content, the number of shares traded is likely to be higher when the report is released than at other times during the year. Everyone is different. We all interpret same piece information differently. Some investors will buy more shares and some will sell their shares after earnings announcement with information content. This will be result in change in price and volumes. Price and volume were the two variables used in the research. Anyway, investors will react to the earnings announcement having information content. This is what information content means in the paper. The methodology used by Bever involved an assessment of trading volume and price of the company stock 8 weeks before an earnings announcement and 8 weeks after the earnings announcement. Bever looked for a statistically significant change in trading volume or stock price, mainly using regression model. The price is indication of expectation change of the market as a whole. Bever hypothesized that a positive price change would be caused by a positive announcement, and a negative price change would be caused by a negative announcement. Additionally, volume is indicator of change in individuals' expectations. The researcher hypothesized that an increase in trading volume would mean that the announcement contained valuable information that would change the optimal portfolio for individual investors even if the overall price did not change. However, selected his sample of data. This study is based on a sample of annual earnings announcements released by 143 firms during the year 1961 to 1965. Other firms here were in New York Stock Exchange and on the CompuState tape to ensure coverage of a larger percentage of total market volume. Bever excluded the firms that reported results on December 31st to prevent including noise from the cluster of announcement at the year end. Similarly, Bever excluded firms that announced the dividends or stock splits to avoid ambiguous noise. Bever controlled for the overall market effects by selecting stocks with random announcement dates. Table 1 indicates how each criteria affected the sample size. Now I will pass over to Xiaoke for the rest of the paper. Thank you.
Thank you, Wenzhe. I'm going to talk about the value analysis, unadjusted for market influence in the paper. BJT is computed for each week T in the report period for each of the 506 earning announcement J. The report period is defined as 17 weeks surrounding the announcement day, which is 8 weeks before the announcement week and 8 weeks after. The dotted line denotes the value of the VT in the non-report period. The important finding in this analysis indicate that there is a significant increase in value in the announcement week, which is week 0. It can tell those investors may delay their purchase and sale of the security until the earnings report is released. The motivation for the value analysis adjusted for market influence is to prove strong evidence to separate effects of the earning announcement in the market-wide perspective and reduce noise in the value data, such as attempt to remove the effects of the market-wide events upon the individual security value. The author made a comparison between the value in the report period and in the non-report period. And another comparison involves the analysis of the frequency of positive residuals in each report period week as compared with the number during the non-report period. Since not all the earning announcements of 715 firms are released in the same week, this will tend to induce the bias against the earning report since value activity increased in the non-report period by the inclusion of the 209 report period. The extent of this bias could be serious because one of the reasons for placing a report of the 209 group was the announcement of earnings and dividends in the same week, which will produce even more price and value activity than the 506 announcements studied. The findings in residual analysis for the report period is that the value in week 0 is unusually high value. In sum, the behavior of the volume uniformly supports the contention that earnings have the information content for individual investors. The behavior of the volume in residual is the same as that of the previous analysis. There is a large peak in week 0, where the mean value is approximately 30% higher than during the non-reported period, and is about 40% higher than the mean value in the weeks prior. Next, I'm going to show you the price analysis. RIT is a measure to the price change of security I during time period T, and IMT is a measure of the averaging price change during the time period T for 425 industry NYSE firms. In price residual analysis for the report period, U averaging across J was computed for each of the 17 weeks of the report period, and the result appears the graph below. The magnitude of the price change in week 0 is much larger than the average during the non-report period. In summary, the behavior of the price change uniformly supports the contention that earnings report possess information content, observing a price reaction as well as a value reaction indicate indicate that not only are expectations of the individual investor altered by the earning report, but also expectation of the market as a whole, as reflected in the change in the equilibrium price. The purpose of this analysis was to discover if there is any clustering or other news announcement around week 0 that might possibly account for the value and price reaction. However, it is conceivable that dividend announcement might cluster in week immediately prior to and after week 0, or there are other types of announcements such as management earning forecasts might cluster in week 0 too. To examine this possibility, the currency or other news announcement in the Wall Street Journal during the 506 report period was examined as the Table 7 shows. The value and price reaction in week 0 doesn't appear to be attributable to the clustering or other new announcement. Next, I'm going to pass to Wenju to talk about the conclusion of this paper.
So in line with the hypothesis, the earnings announcements are positively correlated to price change. Positive earnings announcement will result in increase in stock price, and a negative earnings announcement will drive down the stock price. Also, earnings announcements have impact on trading volumes, meaning investors either buy more stock or sell their stocks after earnings announcement. The work of William Beaver's study shows the value of the financial statements by demonstrating that company financial statements contain valuable and sometimes timely information content.
In this paper, the information content of security prices, it talks about the relationship between price changes and earning changes as previously observed by the Brown and Ball study. It provides a basis for inferring from prices the earning process and the expected future earnings as viewed upon by market participants. By expanding information on earnings expectation and previous earnings history, we are able to grasp a better knowledge on price and earnings by using process models. In these findings, we will see that preliminary evidence indicates that price-based forecasting models are more accurate than random walk with drift modeling and use price as the sole indicator of earnings. To start, the stochastic process of accounting earnings. Stochastic modeling is a form of financial model that is used to help make investment decisions. It helps forecast the probability of various outcomes under different conditions using random variables. It presents data and predicts outcomes that account for certain levels of unpredictability of randomness. In this process, earnings can be characterized as a signal from an information system. Prices will be characterized as if they were a function of the future expected earnings, and price changes will depend upon changes in expectation regarding future earnings. The change in expectation will in turn depend on both earnings and other information. The study goes over two process, simple and compound process. Starting with simple process, if earnings were a simple process as described in the expression, it would only contain information of impact earning events and no price implication. Prices would not convey any information not already contained in the past earnings. Price changes can reflect both earnings and other information. As a result, price may contain information about future earnings that are not reflected in the current earnings. For example, price can contain information about future earnings due to annual earnings viewed as an aggregation of earnings for shorter time intervals. Events like anticipated strike or discovery of oil does not affect the future earning, and when earnings are a compound process consisting of more than one stochastic variable. Earnings as a compound process is a broader class of stochastic process. In simple process, prices would not convey any information not already contained in the past earnings, but in this model, earning process is viewed as two processes. The first process reflects earning series that reflect events that also affect prices. The second process, current earnings, represent the impact of earnings of adjustments or events that have no effect on the security prices. And in this case, prices provide information regarding the first process that cannot be extracted from earnings because of garbling. The characterization of earnings as a compound process is critical to understand the rationale for grouping the data, and is also critical for reconciliating findings with those of previous research based solely on past realizations of earnings. Next, we will move on to the relationship between security price changes and earnings. In this situation, we will introduce the valuation assumption for each security. All other factors that might influence price are implicitly embedded in variable P. Factors like interest rate, risk, dividend payout, earnings growth, and accounting methods used to derive earnings. If price does not vary over time, the percentage change in prices will equal to the percentage change in expected ungarbled earnings. If percentage changes are a function of other factors as well, at the empirical level, it will be assumed that if such price changes affect existence and they are uncorrelated with earning changes. In the second picture to the left, P cancels out, which means price does not need to be a constant across securities. Next, I'll pass it on to Xiaoqing.
Thank you, Christine. Next time, we'll go over preliminary empirical results regarding the relationship between price changes and earnings changes. The authors combine the link between past and future earnings with the link between prices and future earnings to provide an interpretation of the contemporaneous relationship between price changes and earnings changes, then apply their model empirically in the following form, where T includes the year from 1958 to 1976. Capital GIT is percentage change in price for security I in year T, and small letter GIT is percentage change in earnings per share before non-recurring items for security I in year T. Moving on to the predictions of the regression coefficients. Previous research suggests that earnings behavior is well approximated by a random walk. If earnings are a simple process, the regression coefficient is expected to be 1. However, if earnings are governed by a compound process, then percentage change in earnings per share for security I in year T contains measurement error. The results at the individual security level provide a benchmark against which to compare the effects of grouping the data. Given the apparent robustness of the random walk model in previous studies, the authors considered assumptions of intersecurity homogeneity is a logical first step in their initial study, and it can be served as a benchmark for subsequent research using alternative assumptions. Next, I will go over the results at the individual security level. The results of the 19 years are reported in Table 1 on the right. The average regression coefficient is 0.12, with each year's coefficient between 0 and 1. This result is inconsistent with the joint assumption of expression 5 and the symptom random walk process that the expected slope coefficient would be 1. The analysis suggests that earnings are not perceived to be well approximated as a random walk from the perspective of other information reflected in prices. The apparent disparity between the two types of evidence can be resolved by viewing earnings as a compound process as described in expression 4. The results are implying that the inequality of expected value would be expected if earnings were a compound process. Moving on to grouping by the percentage change in price. Grouping is one approach that has been used to reduce the errors in variables problem. The error in variables problem is reduced if the grouping procedure is uncorrelated with the error and is highly correlated with the underlying variable. In this case, the underlying variable is the change in expected ungarbled earnings, and the error is a function of white noise in previous year, events that have no effect on security price in year T and in previous year, which the percentage change in price will be uncorrelated with, and it is expected to be highly correlated with changes in permanent accounting earnings. The authors assume that the portfolio grouping by the percentage change in price will produce the properties on the right if assumptions are met. Ordinary least squares procedures will produce consistent estimates of the slope coefficient. In order to obtain regression coefficient on the group data for each year, the securities were first ranked according to the price change in price, then grouped into portfolios based on the percentage change in price. The process was repeated for grouping into 50, 25, 10, and 5 portfolios. Table 1 reports the results of cross-sectional regression for the years from 1958 to 1976. The average slope coefficient increases as the data are grouped into fewer portfolios. As data are grouped into portfolios according to percentage change in price, the inference of the error functions is diversified away. The regression coefficient becomes a consistent estimate of 1 minus theta, through which the earnings reflect the cumulative effects of white noise in year T with a lagged response. The results of the cross-sectional regression suggest that earnings are not a simple process. Rather, earnings are a compound process implying dramatically different behavior than that implied by a random walk, and prices were used to extract information about this compound process. In order to provide evidence on the robustness of the findings, two other security price variables were used as dependent variables. The first was the security return including dividends of security I in year T, and the second was the residual return of security I in year T. Table 2 provides a comparison of the mean estimate of the slope coefficient under each specification. In all three cases, the coefficient increase as portfolio aggregation increases, and the mean slope coefficient at the 5 portfolio level is approximately 2. The coefficient appears to be essentially invariant to the choice of the dependent variable. The percentage change in price and the security return formulation produce familiar results probably because cross-sectional differences in dividend yields constitute a minor portion of the cross-sectional variation in the security return. The similarity of the mean coefficient in the residual return of security with those in the other two specifications is consistent with there being no correlated omitted variables, inferencing the magnitude of the coefficient in year T. The residual return deals with correlated omitted variables only to the extent they would be in the adjustment. Moving on to temporal aggregation of earnings. If earnings are a compound process, the empirical results imply that change in earnings has positive serial correlation and earnings has a lag response to white noise in year T, deriving from temporal aggregation of earnings. Temporal aggregation of earnings has several implications. The first is the relative importance of the gobbling variable earnings requires to induce near zero first-order correlation in change of earnings in year T is not as large as implied by the analysis in the previous section. The second is temporal aggregation disguises the character of the underlying series, and all security earnings behave identically at the annual level. The third is studies of quarterly earnings may be subject to as much as aggregation as annual earnings. If the pre-aggregated series is in fact perceived as a weekly, daily, or continuous process, quarterly earnings are effectively as aggregated as annual earnings. The fourth is that the accounting system may be reporting these events in a timely fashion, but the temporal aggregation into annual earnings induces a lag response relative to price changes. In general, the authors conclude that future expected earnings, as perceived by market participants, differ dramatically from that implied by a simple extrapolation of past earnings. Next, I will go over subsequent growth behavior. According to the authors, two elements are affecting earnings based on the decomposition of the compound process. One is those events related with stock price. The other one is those events independent of prices. The decomposition of these two elements suggests that earnings reflect events related to stock price with a lag. If so, the percentage change in price in year T is expected to be positively correlated with the percentage change in earnings in subsequent year. Table 3 reports the slope coefficient of earning growth in subsequent year on the percentage change in price, the security return, and the residual return. Based on the interpretation of the slope coefficient in year T is greater than 1 as evidence of a lag response, the authors find it less likely that the inclusion of additional variable would alter the basic finding of a lag response. Lastly, I will go over the reinterpretation of price-earnings ratios. The compound earnings process provides reinterpretation of the price-earnings ratio and its positive correlation with subsequent earnings growth. The authors extend the contemporaneous relationship between prices and future earnings growth one step further than that from previous study by also uncovering a relationship between price changes in year T and earning changes in subsequent years. In addition, the author's interpretation of the price-earning ratio reversion is exactly the opposite to that by Baek-Soo. Baek-Soo viewed this as evidence of the lag behavior of prices as a form of market inefficiency. As a result, price-earnings ratios in year T were used to forecast the security return for security I in future years. On the other hand, the authors consider the price-earning ratio reversion occurs at least in part because earnings are a lag function of price. Because of the lag feature, they use price and earnings information to forecast percentage change in earnings per share for security I in subsequent year, rather than forecast the security return for security I in future years. Now I will pass it to Christine.
Using price to forecast earnings, viewing earnings as a compound process not only implies an interpretation of price-earning ratios but also provide a basis for forecasting earnings. By using the simple price-based model, it is able to forecast earnings by using the equation to forecast the value of earnings growth in each year. For each year, security was assigned to one of the 10 portfolio based upon its price-earning ratio in that year. The median growth for each portfolio was computed to each portfolio for the subsequent year. By using this growth rate, we are able to forecast earnings. With compound process, it is based solely on the earnings series. It is a random walk with a drift. In this model, the use of price is taken into account that allows a better forecast of earnings. To sum it all up, earnings can be viewed as a mixture of two processes. Price is used as a surrogate for additional information available to market participants. The relationship provides an interpretation of the contemporaneous association between price changes and earning changes. It also provides a basis for inferring from price the earning process and the expected future earnings as perceived by market participants.
Now let's make some conclusions for these three studies. First, the studies build upon each other and reference the relationship between prices and earnings. Earnings announcements were used as evidence in the Ball and Brown study, but in the Beer study, it referenced past earnings and past prices to show better analyze and includes a forecast model. Second, results from the Beaver study extended the relationship of the Ball and Brown study. It went one more step by uncovering a relationship between price changes in year T and earnings changes in year T plus 1. Next, Ball and Brown study grew the data by the earnings variables, while Beer study grew observations by the percentage change in price. Last, all the data and observations in these three studies are outdated already, so we believe that more evaluations are needed for updating the models. This is all the presentation. Thank you for listening.